Welcome back to the deep dive. Today we're tackling a really interesting one. SG Finserve Limited, or SGFL.
Right.
Our mission is to get under the hood of their Q2 FY26 results. Look at the strategy, the growth, but also, well, some pretty big management changes that happen all at once.
Yeah, that definitely caught my eye too.
hmm
So for anyone new to them, SGFL is an RBI-registered NBFC. Think of them as a tech-focused company smoothing out supply chain finance SCF for Indian MSMEs.
And they've got strong backing, right? Credit rating.
Oh yeah, stellar ratings,
Yeah.
AAACE and A1 plus carat. Basically, that tells you they're seen as very stable, very low risk in terms of meeting their financial commitments, a secure setup.
Okay, secure. And that security somehow translates into, well, this headline number from Q2 that just jumps out. Their loan book EOP, end of period, hit INR 2,878 crores.
It's a huge number.
Huge. I mean, 15% growth quarter on quarter is good, but the really striking part, 250% year-on-year growth compared to the first half of last year, H1 FY25. That's explosive scaling.
Absolutely explosive.
So, okay, let's break down the financials supporting this. It's not just about growing the loan book, is it? They're actually making money.
That's right. Profit after tax, the PAT, came in at INR 28.40 crores. That's up, what, 16% from the previous quarter? Pretty solid.
Yeah, solid. And operating income?
That climbed too. INR 74.72 crores, up 11% quarter on quarter. And net interest income, NII, which is, their core lending profit, was INR 44.39 crores. It's all moving up.
But the number that really defines SGFL, the one everyone talks about, it's not the growth, is it? It's the asset quality.
Exactly. That's the showstopper. Despite this massive growth, they're still reporting NIL gross NPA and NIL net NPA, zero non-performing assets.
Zero in finance. That feels almost unbelievable. How can you lend out, what was it, over 52,000 crores in 3 years and have zero defaults? What's the trick?
Yeah, it sounds like magic, but it's actually a very specific discipline risk strategy. They only fund receivables or payables that are tied to India's absolute top-tier corporates. Think the top 50. They call them anchors.
Okay, so they're backed by the big guys, like Tata, Mahindra, you mentioned.
Exactly, those kinds of names. By sticking to transactions guaranteed by these giants, they basically strip out a huge amount of the inherent risk.
Okay, that makes sense for reducing risk, but security is one thing. Getting the money back if someone does delay, how do they enforce that? Because lots of lenders have security but still face collection issues.
That's where their, let's call it, unique enforcement tool comes in. So 87% of the loans are secured, typically against inventory or receivables. But the real kicker is a contractual thing called the stop supply arrangement.
Stop supply arrangement. Tell me more. That sounds serious.
It is. It's the ultimate leverage. If a dealer or distributor they financed is late or defaults on a payment, the anchor corporate, the big company, is actually obligated by contract to stop sending them any more goods.
Wow. So no payment, no product?
Precisely. It basically forces the borrower's hand. If they want to stay in business, they have to pay SGFL. It makes defaulting incredibly unattractive, almost impossible.
That is some serious contractual muscle. It explains the zero NPA, but it also means they're heavily reliant on those anchor relationships working smoothly, doesn't it?
It certainly does. It's a concentrated bet, the clearly one they are comfortable with. And, looking quickly at their leverage ratios, they're playing it quite conservatively.
How so?
Well, their debt-to-equity ratio is just 1.77. That's pretty low, meaning they aren't borrowing aggressively to fuel all this growth, and the total debts to total assets ratio is 0.63. Again, conservative.
Okay. And what about efficiency? ROA, ROA?
Also looking healthy. Annualized return on assets, ROA, is 4.50%, and return on equity, ROE, annualized is 10.71%. Those basically tell you they're doing a good job turning assets and shareholder funds into actual profit. Pretty efficient.
Right. Now, here's where it gets a bit more complex, maybe. Despite the growth, the zero risk, the numbers show their yield actually dropped in Q2.
Yes, that's correct.
The interest income divided by the average loan book, it went from 12.4% in Q1 down to 11.5% in Q2. Why would they accept, what is that, nearly a full percentage point drop in their returns?
Yeah, it was a 90 basis point drop, technically, and management was quite open about this. They said it was a deliberate, strategic choice.
Strategic? How?
They onboarded some very large, very high-quality new anchors. They specifically mentioned names like Tata Motors, Mahindra, and Mahindra, Tata Steel. Getting those kinds of blue-chip relationships locked in means high volume, guaranteed safety. But the trade-off is a lower initial yield, around 11% for those specific deals.
Okay, so they're consciously sacrificing some margin now to secure these massive, super safe relationships for the long haul. Makes sense. But doesn't relying only on the top, say, 50 corporates create a different kind of risk, concentration risk?
That's a fair question. Absolutely.
I mean, if a whole sector like auto or construction takes a downturn, isn't their entire portfolio vulnerable, even if the individual companies are strong?
It's definitely something they have to manage. And
Yeah.
they do that through diversifying within those anchor relationships across different sectors. Right now, building materials is the biggest chink, maybe around 60%.
Okay.
But IT peripherals and mobiles and the auto sector, they're each around 20%. And the plan is clearly to bring down that building material share gradually as these newer anchors, like the auto ones, really ramp up. So yes, concentration exists, but they're actively trying to rebalance it, trading one risk for another, perhaps.
Right. Trading specific company risk for broader sector risk, maybe? And their future growth clearly hinges on deepening these big anchor ties.
Completely. They have MOUs, memorandums of understanding, signed with anchors that total up to a potential INR 6,550 crores in financing lines.
Wow.
And that's up by over 1,000 crores just in the first half of this fiscal year. We're talking major players: Tata Group, Vedanta, Ashok Leyland, JSW, MG Motors. These MOUs aren't guaranteed business, but they show the pipeline, the potential scale they're building towards.
Okay, pipeline looks strong. But speaking of the future, we have to talk about let's call it the elephant in the room. The management changes announced right alongside these great results. That seemed abrupt.
It was certainly surprising timing, wasn't it? Given how well things seemed to be going. The board meeting confirmed CEO Saurabh Dhawan resigned, effective November 3rd, and then the COO and CFO Sahil Sikka also resigned, effective December 31st.
So the CEO and the joint COO CFO, the two key people driving this 250% growth, leaving almost simultaneously within like 60 days of each other.
Yeah, staggered, but very close together.
How does a company maintain stability and strategy through that? That's usually a red flag for the market, isn't it?
Management definitely moved quickly to reassure everyone. They stressed that the departures weren't coordinated and that there's a structured handover plan over that 60-day window. Their core message was, the SGFL system, the process, is strong enough to handle this. It's not about individuals.
Okay, so what's the plan? Who's stepping in?
They've brought in some serious experience. The new CEO is Vinay Gupta. He's a chartered accountant, got over 20 years under his belt in banking, and importantly in supply chain finance. He's set to join by November 24th, so there's a bit of overlap.
Okay, that overlap is crucial. And the finance side, the CFO role.
That's an internal promotion. Sanjay Rajput, who's already the head of finance and accounts, is stepping up to CFO from January 1st. Promoting from within often signals continuity, keeping that institutional memory.
Makes sense.
And they're also adding a dedicated head of internal audit, Saurabh Mishra, who's joining soon too, bolstering governance.
And they made a point about their process, didn't they? Something about committees.
Yes, that was key to their reassurance message. They highlighted that their credit approval isn't down to one person, like the CEO or CFO. It's a committee-based decision process.
Ah, so they're arguing the zero NPA discipline is embedded in the institution, not just in the departing managers.
Exactly. The system is the safeguard, not the personality. That's the argument.
Okay, let's pivot to the future then. They've laid out some really ambitious targets, but you mentioned they hinge on getting some new capital in first.
That's the critical piece, yes. These forward-looking numbers depend on converting INR 338 crores worth of warrants into equity shares by April 2026.
Right.
Assuming that money comes through, the big target is an AUM, assets under management, basically their loan book of INR 6,000 crores by the end of FY27.
6,000 crores, that's more than double where they are now in about 18 months.
It's aggressive. And based on that scale, they're targeting an FY27 profit before tax, PBT, of INR 250 crores for the full year.
Okay. And where do they expect to end this current year, FY26?
The expectation is to exit FY26 with a loan book around INR 3,500 crores. And to support that kind of growth, assuming the equity conversion happens, they're planning to raise about INR 4,500 crores in additional banking limits. It signals real confidence in their expansion plans.
Okay, wait a second. We just talked about how they strategically lowered their yields to get those top-tier anchors on board.
We did.
So how do they plan to hit these massive profit targets like 250 crores PBT if their average yield per loan is actually lower now? Something has to change, right? This must be where the strategy shifts.
Is the pivot, exactly. They expect their net interest margins, NIMs, to actually expand by about 100 to 150 basis points going forward, despite the lower anchor yields.
Expand.
By
Okay.
moving deeper into the supply chain. They plan to go one level down from the main distributors they currently finance and start directly financing smaller retailers those distributors sell to.
Ah, okay. Financing retailers, that sounds riskier though. Smaller businesses, potentially less stable. How does that fit with the absolute focus on zero NPA?
That's the clever part, or at least the plan. They're building in risk protection using the distributors themselves. Two main ways. First, they require the distributor to have some skin in the game, meaning the distributor shares some of the risk.
Okay.
And second, they're using something called a first loss guarantee, or FLG.
First loss guarantees. Can you break that down simply? What does that mean in practice?
Think of it like the distributor providing a kind of insurance on the loans to the retailers they recommend. The distributor guarantees they'll cover the first slice of any losses, say, the first 5% or 10%, if those retailers default.
I see. So SGFL takes on the retailer loan, gets a higher interest rate for the higher perceived risk.
Right.
But the initial buffer against default is actually provided by the distributor who knows the retailer best and has an incentive to only bring in good ones.
Precisely. It allows SGFL to chase higher yields further down the chain, but they've offloaded that first layer of risk back onto the distributor. It's smart risk structuring.
Yeah, that sounds quite sophisticated, but managing thousands of smaller retailer loans plus these FLG structures, that must require some serious technology, right?
Oh, absolutely. This whole strategy relies heavily on their tech platform. They already have their own scoring and credit rating model live, which they'll use for these retailers.
Okay.
And crucially, they're developing an AI-driven tool specifically for monitoring credit risk in this segment. That's supposed to go live by the end of this year, December 2025.
AI monitoring. Interesting.
Plus, they've launched an Android mobile app for customers. That's key for interacting with potentially thousands of smaller borrowers in real time, managing transactions and engagement.
So the tech backbone is critical for this next phase,
Mhm.
but we need to bring us back to the present reality. Despite the strong Q2 and these ambitious plans, management did have to cut their profit guidance for the current year, FY26.
Yes, that's an important reality check.
They were initially guiding for, what, INR 150 to 160 crores in profit after tax.
That was the original range.
And they lowered that pretty substantially down to INR 120 to 125 crores. That's a big adjustment. What reason did they give for that?
The official explanation was the broader macroeconomic slowdown happening across India. They pointed specifically to weakness in sectors like construction, automotive, and consumer discretionary spending. Essentially, their big anchor customers are seeing less demand, so those anchors are trimming their own forecasts. And if the anchors are doing less business, there's simply less financing needed throughout their supply chains. Less volume for SGFL to fund.
Right, it flows downstream. So faced with that slowdown and needing to cut guidance, why didn't they just, as they apparently put it, get adventurous? Why not chase some riskier, maybe tier 2 or tier 3 clients to try and make up that shortfall with higher yields?
And that, I think, really speaks volumes about their core philosophy. Management explicitly said they made a conscious decision not to compromise their underwriting standards or risk discipline just to hit the original numbers.
So protecting the zero NPA was paramount.
Absolutely. Maintaining that pristine asset quality, that zero NPA status, was prioritized over chasing potentially risky growth to meet an aggressive target in a tough environment. They chose stability.
And what's the revised expectation now for the rest of the year?
They indicated they still see potential for maybe 10% to 12% quarter-on-quarter growth in earnings per share, EPS, for Q3 and Q4.
Yeah.
So still growth, but definitely more measured, more cautious than originally planned.
Okay, so let's try to wrap this all up. Synthesizing this deep dive, SGFL had a really strong Q2 in terms of growth, and crucially, they maintained that perfect zero NPA record. That's their brand.
It is.
But they're clearly juggling a few things now. There's the strategic move to accept lower yields from top anchors for safety. There's the very real macro slowdown that forced them to cut their yearly forecast. And there's the background noise of navigating the sudden simultaneous exit of their top 2 executives.
That sums it up well. And if you step back and look at the bigger picture, SGFL's success really highlights why this whole supply chain finance model is gaining so much ground over traditional bank overdrafts or cash credits.
How so?
Because SCF provides financing that's tied to a specific transaction, a specific end use. It's inherently less risky for the lender, and it provides targeted working capital right where MSMEs need it in the chain. It strengthens the whole system, really. Financial inclusion, but controlled.
Right. Which brings us to maybe a final thought for you, the listener, to chew on. SGFL has staked its reputation, its entire model, on safety and zero risk, even accepting lower returns initially to guarantee that.
Hmm.
So given they have to maintain that zero NPA status, and given those lower initial yields from the big anchors, does their whole plan to reach that INR 6,000 crore target now rest almost entirely on how well and how quickly they can pull off this next move, this shift into financing retailers using the new tech and those FLG structures? Can they successfully balance higher yield with absolute security down the chain?
It certainly feels like that's the critical execution challenge ahead for them. It's a tightrope they have to walk.